Resume recording. Okay, so today we're here, Wednesday the 10th. I'm just gonna finish us up on the last bit of chapter 11, those subsequent expenditures, and make sure that everyone's okay with that. Your homework for chapter 11 is also due today. I see at least almost half, if not more people submitted already, half of the class submitted already. For the rest that have not yet submitted, I assume that you're in the process of doing that. If you have questions about the homework, you can ask me during the break or at the end of the class. If there's anything that you need clarification on, I'm happy to do it. And then, I'm just reminding you again that starting tomorrow, the quiz and the test for chapter 10 and 11 will be open and available for you to go and complete at your leisure. We're looking at, similar setup as before with the other test and quiz, where you have a 1-week window within which you can complete the work. But of course, as soon as you start, you have to finish the whatever assignment you're doing within the time allocated, meaning that, again, let's say you decide to do something on Saturday, that's fine. But let's say you're doing the quiz on Saturday, you can start it at any time, but once you click start, you have 2 hours and you have to finish it within 2 hours. Otherwise, you will be timed out. All right. And so, you decide when you want to do it. You may still need time to study. If you wait till the last day, that's up to you. But just remember at 6 p.m., everything closes. So if you decide to start the quiz and the test at, 4 p.m., you're not going to have enough time to finish everything. So please just be aware of that. And anything that's marked late is not going to get, points. And of course, the other thing is, if you start stuff late, it's like Murphy's Law. There's always something that goes wrong at the last minute, especially seemingly this semester. I felt like there have been a lot of people who have had internet problems in my classes and internet going in and out. So, you don't want to be trying to do this at the last minute and then your internet is acting up. All right, so I'll go over the test and quiz information again as soon as I finish those last few bits of chapter 11. I'll just go over it and you guys can maybe think of, if you have any questions for me about the format, think about that in the meantime. So that's where we stand for time. The 4 people, I think it was 4 more people who submitted their part B of their papers to me. I returned it to you on Monday already. You should have received an email from me with the link to the document to say that I've commented on your work. And so if you have any questions for me about that, you should contact me, as soon as possible, especially if you're trying to submit early on the 17th. I recognize that the early date for the paper crosses over the window of the test, but remember, this is an optional early submission. This is not a final deadline to submit, so you don't have to submit the paper on the 17th. And I mean, even if you did do that, you would still have the 18th to finish the test. I think, prioritize the quiz and the test, because you can still submit the paper up to the 24th. It's only for 5 bonus points that you would be submitting early. So unless you have your situation so under control that already you've studied for the test and the quiz, you're good and you can fix the paper in time, that's fine. But I just want to be clear that if you're getting confused about where to spend your energy, rather spend your energy on the quiz and the test, because you still have a week from the 17th for the final submission of the paper. All right. So you don't want to find out that you're working to try and submit the paper early and then you didn't study for the quiz and the test. Any questions on timing? Anything that people need to know about time, dates, anything like that? Okay. So, we'll talk again, and I know it might seem like it's, stuck record. I'm always going over the calendar, but I just find that we're also busy. Everybody's, got a million things going on, that it just helps me, and I'm hoping that it also helps you to just keep looking at the calendar and making sure that we're not missing any deadlines. All right. So let me go back to chapter 11 and we can just try and finish this thing up. Just going right to the end where, where I was talking about, about subsequent expenditures. We've been through everything else. I'm not going to belabor those points. So at the end of this chapter, you'll notice that there's this very small section, but it's, it's part of the work, talking about what happens if you make payments on your assets after, after you already have owned them for a while, which of those payments are going to be expenses and which of those payments are going to be capitalized, right? And by capitalized, we mean that it is going to be an asset. So this is about expenditures over the life of the asset, and the company has to choose between capitalizing the expense, so increase the book value of the asset, or creating a new asset, or expensing it in the period incurred. We capitalize expenditures that are expected to produce benefits beyond the current fiscal year. So that means there's going to be future benefits that go into, next year and the following year and so on. And so the way we figure this out is, do the expenditures increase future benefits in the following way? There's an extension of the useful life of the asset. So if I replace the engine on my truck, that's probably going to extend the useful life for a few years, right? So that's going to be something that is capitalized, not expensed. An increase in the operating efficiency of the assets, resulting in either an increase in the quantity of goods or service produced, or a decrease in future operating costs. So perhaps we do some type of improvement on a machine, and as a result, it's producing more of whatever good we usually produce. So that's an operating efficiency increase. So we're going to capitalize that, make it into an asset. That's different from someone, the machine is kind of not operating as well as it usually does. Someone comes in to service it, and now it's gone back to operating as per normal. That's not an improvement. That's just a service expense, and would not be capitalized, right? So you're thinking about, does this expenditure just get you back to where you're supposed to be, or does it take the asset beyond, in terms of the way the asset is behaving? And then an increase in the quality of goods or services produced by the asset. So again, same thing with the machine. Perhaps something was up with it, and you weren't that pleased with the way the items that the machine was producing looked. You get someone to do a rearrangement of the machine or an improvement of the machine, and now the quality of goods are better. So that would also be capitalized, right? So subsequent expenditures fall into four categories. Repairs and maintenance, and this is always expense, right? Additions, improvements, and rearrangements. Additions and improvements always capitalized, right? But rearrangements, it will determine whether it's capitalized will be determined by whether the rearrangement was material. So the amount that was spent is big enough to impact people's thinking about the financials. And then if there's also an increase in future benefits. So if I just go around and rearrange something on a machine that doesn't change the benefits that I get from it, that's not going to be something that will be capitalized. And also if I do a rearrangement but it costs me very little money, I should also just expense that. Now, when you're working at companies, you may also find, and this is mentioned in the textbook, and I remember when I was volunteering at a religious organization, it was the same thing, that some companies will just expense payments that are made for assets that are below a certain dollar amount. So say, for instance, they'll say the threshold is $2,000 or $5,000, and they say anything that we pay for that technically is, an asset, but like, let's say they buy a microwave for argument's sake, but it's below, $2,000, they just expense it immediately. And they're allowed to do that as long as they have a policy and they stick to it consistently. There isn't a problem with that. So I don't want you to get confused, especially if you go and maybe you're already working out in the quote unquote real world, or when you go and work somewhere, thinking that every single thing, that does give future benefits will always be capitalized. In reality, in normal life, that's not always the case, because for how can you call it? It's just easier sometimes for companies to just say, you know what, it's too much paperwork to capitalize this microwave that cost us, $99, and then have to depreciate it over 5 years or something. So it's going to be like $20 a year. Like the amount of book, not book, the amount of labor that goes into doing that doesn't make sense for the cost of the thing. So we're just going to expense it immediately. All right. And so they've basically decided on a materiality amount is $2,000, and anything above 2,000, if it does qualify as an asset, we will capitalize it, and anything below that amount we will expense. So that's sometimes how things in practice differ from, what the book tells us to do. And then the last piece here, we've spoken about this, we've even done an example like this. If you successfully defend an intangible asset like a patent or a copyright or whatever, the legal fees related to that successful defense should also be capitalized. They form part of the asset now, of the intangible asset, because now there's future benefits, right? Because you have the right to use this asset. If you unsuccessfully defend an intangible right like a patent, then the whole thing has to be written off, because you no longer have the future benefits related to the patent, and the legal fees are not providing you with any additional benefit because you lost, right? So you're not allowed to get the revenue from that patent anymore. Does anybody have questions about the theory here before we look at an example? Okay. So we'll go to the example for this. Let me see what the examples are not on here. Just give me a moment so I can open up the chapter 11 stuff. I thought I had it open already and I don't. Okay, so I'm looking at 18, number 18. For those who did download the questions, you can, follow along on your paper, or, just follow along on the screen. It's fine. Demet manufacturing incurred, and this is coming from the textbook. So, you may have, if you were in the homework or in the textbook, you may have seen this question already. Demet manufacturing incurred the following expenditures during the current fiscal year: annual maintenance on its equipment, 5,400. Remodeling of offices, 22,000. Rearrangement of the shipping and receiving area, resulting in an increase in productivity, 35,000. Addition of a security system to the manufacturing facility, 25,000. How should Demet account for each of these expenditures? So I'm going to give you 5 minutes to think through, based on what we just discussed, for each of these expenditures, whether you think it should be expensed or whether it should be made into an asset, so capitalized, all right? So we go from now until 10:55, work through the expenditures and you decide, and then at 10:55, I'll take some volunteers to tell us what they think. Another 3 minutes. Again, we're doing question 18. You're deciding whether it's expenditures or assets. Those are 1, 2, 3, 4 payments that were made. I'll take you, Gian, as soon as the time comes. Thank you.
Is that journals?
No, you don't have to do journals. You just have, we're almost done. You just have to say whether you think it's an expense or an asset. And in about 30 seconds here, I'll get Gian to walk us through it. All right, Gian, go ahead and let me get myself organized here also so that I can actually take your answers. Just 1 second. All right.
So there's a annual maintenance on its equipment, $5,400,
Yeah,
which is expense because it's a maintenance.
right. So the
Yeah.
5,400, it's expensed and it's repairs and maintenance. Yep.
Yeah.
As simple as that.
Yeah, and the remodeling of offices, which is a set. It can be a set because it improves the office.
Capitalized because
it
it
can
is an improvement.
Yeah.
Good.
So, and the rearrangement of the shipping and the receiving area resulting in an increase in productivity, $35,000. Yeah, which is also a set because it increases in productivity.
Good. If it had just said that we rearranged the area, but there was no increase in productivity, then obviously we would expense it. But right now it's capitalized because there's an increase in productivity, which is a future benefit. Perfect. Next.
Yes. And addition of a security system to the manufacturing facility, $25,000. Yeah, which is a set as well because it's addition expense. Yeah, which can lead to the future benefit.
Perfect. Let me just see something did I miss something, please? Yeah, that's fine. Good. Thank you.
Thank you.
Hopefully everyone's okay with that. It's, not the hardest thing we've ever had to do, but I just want to make sure that you understand, like something like a rearrangement is a little bit of a weird word, like a weird name or whatever. So, and it doesn't really sound like something that is a benefit. So now we know that a rearrangement is in fact something that could be capitalized, and you should be already used to these terms, but just in case, remember capitalized means that you're making it an asset. And thanks, Emladol, also for saying that the 5,400 was an expense. That's correct. Okay, so that's the end of the subsequent expenditures piece. There wasn't much much there. And so the loss, so we're done. This is the end of the notes, right? But I did want us to just revisit, I know how much you guys love the codification. So I wanted to just revisit the codification again. I will go through it and show you where the answers are. This is a question out of the 9th edition of the textbook, but I think there's a similar question in the 10th edition. I'm not sure I really need to put that there. I think it was more a note for myself, but I'm going to go into the codification to be able to show you where these bits of information are found. So let's just read this. Access the FASB codification, determine the specific citation. So when they're saying citation, they're talking about paragraphs and sections of the codification for each of the following items. Depreciation involves a systematic and rational allocation of costs rather than a process of valuation. So you may recall, and this feels like it was long ago, but you may recall that when we first started speaking about depreciation at the beginning of this chapter, I had said to you that depreciation is not about valuation and a loss of value, which is often how we speak about depreciation in day-to-day life. That's fine. But as an accounting concept, depreciation is about a systematic and rational allocation of the cost of the asset to expenses as we use up the asset, so that we can match the expense that we're incurring as a result of using the asset to the revenue that the asset is generating. All right. So I didn't just make that up, obviously, and we didn't just blindly follow what the textbook says. The textbook is based on the codification. All right. All the rules and things that we are learning in the class are coming from generally accepted accounting principles, which is all included in the accounting standards codification. So I want to go into the codification so that you can see that. Then the second one is the calculation of an impairment loss for property, plant, and equipment. In our previous session together that we just had on Monday, we went through impairment losses, and we said that for property, plant, and equipment and finite life intangibles, we will do a two-step process for impairment. We look at first the recoverability test, which is looking at whether the undiscounted cash flows from the asset are less than its book value. If that's the case, then the asset may be impaired. And in the second step, we do fair value versus carrying value to work out the loss. Okay, so somewhere, somehow, this is also in the codification, and we'll go and look to see if we can find it. Just know that I want to be clear here. I don't want people to freak out now. I'm not going to ask you codification to go and look for stuff in the codification in the test. Okay, that's not what I'm priming you for. I need to make sure that when you leave me, at the end of the semester, that you have had some exposure to the codification, because not only will this come up in your 4-year schools, but also this is part of the preparation for the CPA exam. And I know that many of you are, planning to take things right through to the end and actually, qualify as CPAs. And we need to get into the habit of being able to find this information. And then the last thing that I'll say is, when I used to work at Deloitte, we often had to go into, and at that time we didn't even have the codification, all the gap, the standards were all over the place. Everything hadn't been brought together in one place. And there were times when I was working at clients when I would have to go and look up the accounting standards for certain things that we needed to talk to them about. So you do have to know your way around around these documents. And then they're asking where's the accounting standard for a change in depreciation method. Remember when we spoke about a change in depreciation method, we said that we do the change prospectively, which means you do it for the current year and future years. You don't have to go back and change everything else that happened before, but you do have to give a reason in your footnotes as to why you changed your method, let's say from straight line to declining balance or something, whichever way you change it, you do have to give a reason, justification. And then the last one is talking about goodwill and the fact that we don't amortize goodwill. And, we spoke about this, that goodwill is tested for impairment, that it's also a two-step test. And this is, in the notes for chapter 11. The first step is you ask if the fair value of the reporting unit is less than its carrying value or its book value. And if that's the case, goodwill may be impaired. And then in the second step, you look to see if goodwill is in fact impaired. You take the difference between the fair value of the reporting unit and the book value. And that's, that's going to be the impairment loss, but it's limited to the book value of goodwill. We did 2 examples like that last time. You'll see the calculations in the chapter 11 example workings, class example working. So I'm just telling you, the background of what these 4 items mean. And now I'll try and go into the codification and actually find the place where it's written, and hopefully we'll be able, I'll be able to find it. Anything is possible, right? So in our Blackboard, I did give you guys a codification link. It's kind of the same place that they're directing us to now. You can also just go to the FASB website and go to the codification and take it from there. What you do is you go to fasb.org. You don't have to buy anything. It's very expensive. If you buy access to the codification, it's almost $1,500. Obviously, that's not what I'm asking you to do. You go for the basic view and you forget even about creating. You don't have to create any type of login. This was in the past. We had access to the codification through the library, but we don't have that anymore. So I have to go through this, and I have to first find all the taxis. Hopefully I found all the taxis. I can't see another taxi here. Okay, so access the basic view. And you just agree to whatever you need to agree to. There's no way to not agree because you have to get in. And so for the first of all, we're going to assets, obviously, because this is all about property, plant and equipment and other types of assets. So there's the accounting standards codification for assets is 360. All right. So that's where you start. And then it's asking about depreciation. So you can go to overall, and go overall means it's just going to show us all the different topics that are there. And then we go down, depreciation is part of subsequent measurement. So, oops, sorry. So I would think that somewhere over here in subsequent measurement, it's going to come up. And so it's 35. And just know that I'm actually looking at a sheet myself. I haven't memorized all of this. Okay, so don't worry. You go into 35, then there's depreciation. And so I'm actually going to just click on this so that we can see what's happening. And so it's 35-4. Here it says, it talks about depreciation. So generally accepted accounting principles require that this cost, is the cost of the asset, be spread over the expected useful life of the facility in such a way to allocate it as equitably as possible to the periods during which services are being obtained. They're talking about facility, but I think it applies to every asset that you have. This procedure is known as depreciation accounting, a system of accounting which aims to distribute the cost or other basic value of the assets less less salvage value over the estimated useful life of the unit. This is the part of the codification that tells us how to do depreciation. Okay, so that's the answer for and let me actually just do it here for exercise 19 for anyone who actually wants to go in into the codification. So it's the FASB Accounting Standards Codification number 360, right? There's paragraph 10, subparagraph 35, and then the section is 4. That's the answer for number 1. Any questions, anybody? Hopefully I'm not scaring anybody about anything. Any comments or questions about this?
I have a question, Professor. When I see the chapter 11 notes, I don't see the codification part. So
what do you mean? You don't see this question?
I don't see the
chapter
11. Yeah.
Yeah, I don't have notes on it because there's really nothing to say other than the accounting standards codification for chapter 11 is ASC 360.
Okay.
I think I understand what you mean. I'm not going to take you through every part of the codification again as a separate section in the notes because we've already done it by going through the whole chapter. This is just putting the codification reference to things that you already know from the chapter.
I see.
Makes sense? Okay. So you know what we could have done, but this would have caused, I think, a lot more I don't think confusion, but a lot more work for people to keep up with. Every time when we do a piece, like for instance here's the depreciation. Let me close this up again. Here's the depreciation stuff. So I could theoretically have put accounting standards codification 360, whatever on here, but it's too much extra information. You even see in the textbook, they'll mention the codification, but most of the time they'll keep it to the end. All right. So consider this us matching up what we were doing before with where you can find it in the codification. So the calculation of an impairment loss for property, plant, and equipment. So going back into 360, and it's 35 as well, but it's 17. Measurement of impairment loss. You see that? And so it's talking about how to, you see it's talking about the undiscounted cash flows and all the things that we've discussed before. So basically this subparagraph 70 or section 17, excuse me, is telling us how to measure an impairment loss. You already know how to do this because we've worked through it in our materials before, but now we actually know where to find it if we ever need to find it, you know, and then the question becomes, you know, do we ever need to find it? Well, you'll be asked to find it certainly in the future when you're studying for the CPA or when you're at the 4-year school, or maybe you know, for other purposes that I'm not able to think about right now. Accounting for a change in depreciation method. All right, so here we have different sections. I'm going to go back up, right? So, sorry. When you look here, do you see accounting changes and error corrections? So all the changes and corrections are being treated in a separate section away from the actual topic. And I think part of that, the reason for that is because there's some overall rules anyway that apply to many different topics. So it would be too repetitive. So it's going to be 250, 10 again overall, right? And it's 45. And again, you don't have to memorize this. Don't panic. I'm just showing you that this is where these things exist, okay? 45 and then 18. We're talking about a change in the depreciation method, which is a change in accounting principle. And this, you see here, the new depreciation method is adopted in partial or complete recognition of a change in the estimated future benefits, etc., etc. So I'm not going to read all of this. We already know that it's a prospective change, but this is where the answer can be found. All right. So it's FASB ASC 250. And why am I doing this, right? Some of you are like, ugh, why do we have to go through this? I found in my many years of teaching this class that the one thing that students are often like least inclined to do is to actually access the codification because it's very scary. It's a big, big thing that we may not know exactly what it's for or how to get there or whatever. So this is just me trying to help to show you that it's kind of scary, but it's also, it's something that with a little bit of practice, you can find the answers. So goodwill should not be amortized. Where does that come from? So there's assets, the intangibles, goodwill and other, right? And 350, so 20 is goodwill specifically, all right? And subsequent measurement has always got to do with amortization, depreciation, depletion, impairment. So we're looking under subsequent measurement. And so let's click on that and see what it says. And there we have it. Goodwill shall not be amortized. Instead, goodwill shall be tested for impairment at a level of reporting referred to as a reporting unit. Now, based on the work that we did, you already know this, but I'm showing you where you can find this should you ever be called upon to do so. Okay. So FASB, ASC, it's 350, it's the goodwill section, it's 35-1. Okay, so there again, hopefully I'm shedding light on what's going on in the codification. If you look, sorry, that was not my intention of doing that. Let me stop the share because I don't want to put people's business on the street here. If you go into the textbook, just 1 second. Just bear with me. I want to see if I can find this for you. Okay, so if you go into the textbook and you want to find the stuff to do with the codification, it's often near the end of the chapter, and they do ask the questions, but they don't really integrate it, in my opinion, as well into, I was just trying to see again if I was mistaken about feeling like they don't integrate it into the materials as well. But if you go near the end of the chapter, I think the section is called bottom line or something, they mention the codification there, but these questions that I'm asking, like this one over here, this is actually from the textbook. So to some extent, you are expected to know where to find the information, even though, the textbook doesn't necessarily guide you specifically on where to find it. So questions, anybody about the codification, about your responsibilities as it relates to the codification? Talk to me. Any other questions? Okay. So then that marks the end of this chapter, and I'll try again with the next chapter, which is 12, to to do the same, to visit the codification a little bit and get us more and more comfortable with it. So now that we've completely finished chapter 11, I just want to go back and walk through again everything to do with the quiz and the test, and want to leave room open for you guys to ask me any questions in case there's something that you need me to give further clarification on. So it's obviously in McGraw-Hill, same as before, opens tomorrow, closes next Thursday. The test again counts 15% of your grade. The quiz is 3%. Please do the quiz before the test. I'm not extending the deadline unless, there's something happens and you have documentation to back up whatever is going on and you need some extra time. Like I said, you have a 1-week window to take both of the tests and the quiz, but they are timed. So, once you start, you have to complete. For the quiz, it's 2 hours. For the test, it's 3.5 hours. So it's the same as before. There isn't a pause button, and the clock is going to keep ticking. Even if you close your browser, I'm sure you've experienced this. So make sure you find a time when you are ready to do the work, when you have a proper internet connection, when you have quiet in the house or wherever you are supposed to be working. Just make sure that you find a good time to do this. You have 3 attempts again at the test questions. For each attempt after the first attempt, 4% is deducted from your score. So remember how McGraw-Hill behaves, that it's not taking the points off the actual question that you're fixing, it's just taking the percentage off your overall score. So if you finish the test and you have 99%, for instance, you're probably better off just leaving the test like that and not trying to go back in, because if you go back in, it's going to take 4% off your whole score. So even if you fix the 1% issue that you got wrong, your score will actually end up being lower on your second attempt than on your first attempt. So you guys decide whether you want to go in and out for multiple attempts. The 3 attempts are really more there for people who are really struggling, with the work and want to try and get as many points as possible. It's less so for people who are getting, an A already on the first attempt. You probably are not going to benefit from going in and out using multiple attempts. So I did decrease this. In the first test, it was taking off 6%. Now I decreased it to 4, and then with this as well, I decreased it from 4 to 2%. So you have 3 attempts on the quiz questions. Again, after the first attempt, if you go in, your score drops by 2%. So if you got 9.9 or 99 or whatever on the quiz for your first attempt, or 9 out of 10, then if you go back in, you get a penalty for taking an extra attempt, regardless of whether you fix the answer on the question or not. So, this is what our McGraw-Hill operates. This is not me. I don't have an option to change that. So just think carefully about, how much studying you're doing, how careful you are on the first attempt. People were generally good on the previous test and quiz. So I know there were some people who had a little bit of difficulty, but for the most part, you were okay. So I think everyone kind of knows how this works. 10 multiple choice questions on the quiz. It's calculations, journal entries, numbers and so on, not definitions or theory. In the test, there's a combination of theoretical questions and calculations and so on. So it's going to be a mix. And then I was still trying to finalize. I'm still trying to finalize some of the questions on the test. What I'm finding is that I wanted to, have I guess 4 or so actual big exercises that you guys could do, but I'm finding that I'm really able to only find smaller questions, where it's just like this one thing that you have to answer. So in the end, instead of having 4 or 5 bigger exercises, you may find that there's a few more exercises, but they're really short, if that makes sense. So, whereas I wanted an example, and I'll see if I can still find this. I was looking for an example that is testing all the, depreciation methods in one question. And I've not been able to really find a good example like that. I may still find it later tonight in the system. I've been, clicking around trying to find it. So if that doesn't happen, then I'm going to have to ask like 2 or 3 separate questions on depreciation. One is straight line, one is units of activity, and so on. So I will probably send out an update when I'm fully comfortable with everything that's in the test. But just know that instead of having 4 big exercises, you may end up with 6 or 7, but it's much smaller exercises where you're just being asked to give one amount or one journal entry or something like that. Do you guys have questions about that? I want to make sure that what I'm saying is clear to you, that, you know, whereas I would have, I was looking for an exercise that was just one big thing and it's all being tested together. I'm now having to split it up into smaller things, which may actually be more to your benefit, honestly, because you know, if you don't know one thing, you can just move on. Questions about that, or are we good? No news is good news. Okay. All right. So other than that, I think the only thing that I'll say again is that you want to just look at the listing of topics to make sure that you are clear that you have actually covered, you know, these topics in your studying, because any topic that's not covered in the exercises will come up in the multiple choice questions, right? So if, you know, if you're not seeing anything about a particular topic over here, right? Like, let's say impairment of indefinite life intangibles, then it's probably going to be a multiple choice question. So that's the way to be thinking about this. So if you need to print out the sheet and do a completeness check that you've studied for everything, please do that. All right, so that's all I have to say about the quiz and the test right now. Again, I'm opening the floor another 30 seconds in case anybody has questions about this. Otherwise, we can go on a break before we move on to chapter 12. All right. So I'll step away from my desk here for a few minutes during the break, but when I come back, if there's anybody who has questions on the homework for chapter 11, I'm open to hearing from you. Otherwise, let's take a break from now, 11:25 until 11:35. And when we come back, we'll spend some time in chapter 12, which is about investments. Okay. So break till 11:35. All right, I'm back if anybody wants to ask me about anything.
Professor,
Hi.
hi. Can I ask about research paper?
Yeah, well, you're asking me now with a minute to go before the end of the break, so you can ask, and if the answer is too long, I'll answer you at the end of the class.
Okay, just quick question.
Okay.
Yeah, if I submit the early option date,
Mm-hmm.
is it possible to submit again the final submission?
No,
Only once.
no, one and done, because I'm gonna mark whatever you. Okay, so that was a short question, so we're good. I'm gonna mark that early submission date is not a draft submission, that's your paper. So whatever the grade is at that point, that's it. Mhm.
Understand. Thank you.
Okay, thanks for asking. All right. So in the next chapter, we're really changing gears quite a bit here, and moving into investments. And for the most part, I think, if I think back on the accounting syllabus up to now, in accounting 2, in that textbook, there is a chapter on investments, but it's not covered at that point. So this is probably, the first time that we really dig deep in, the accounting program into investments. And what's going to happen in this chapter is that there are two types of, broadly, two types of investments that we will discuss, and it's debt investment. So, where we're investing in the debt of a company, and the other side is equity investments, where we're buying stocks, right? Stocks of another company. So you have to be careful here now not to get confused about which side of the transaction we are on. In the past, and this is in other accounting classes, when we were speaking about bonds payable, or those types of things, bonds payable, notes payable, mortgage payable, we were looking at that payable as our liability, and we had borrowed the money. All right, I'm sure you guys remember this from before. You were the one who borrowed the money, so you have to pay the money back, etc., etc. What's happening now is that we are not the borrower. We are the lender. We are the ones who are actually making the investment. We're giving the money to the company that is issuing the bond. And so it's an asset for us. Okay, I want you to think about that carefully, because we need to not be confused from, the first moment that we're talking about this. You are an investor who is standing with a whole heap of money and putting your money into a company, either in the form of buying the stocks of that company, or you are buying the bonds of that company. All right. So all of this is assets for us as the investor. Hopefully that's clear. So again, investments are generally classified as either debt investments or equity investments. And accounting for those investments involves the measurement of the investment. So the initial measurement, like what are you going to record the investment at when you first buy it? How are you going to recognize it at fair value, at amortized cost, or whatever? And what are you going to put? Disclosure means what's in the footnotes of the financial statements, relating to that investment. So for now, and today I'm going to take us to a point, but I'm not going to push us too hard, because I know you guys are, you have your mind on the homework for chapter 11 and also on the test and so on. So we'll talk a little bit. I'll probably do 1 or 2 examples with you, and then we'll kind of be done. But if you can just tune in here for a bit, so that we at least set ourselves up. I think we have after this 2 or 3 more sessions for chapter 12, so we'll be fine time-wise. So debt investments are instruments. So instruments is, a fancy way of just saying that it's something, a thing, right? A financial, whether it's a document, and that represents a creditor relationship with an enterprise. Very fancy way of saying you as the investor gave your money to the company, you bought the bond, the company now owes you the interest on that, and they also owe you your money back at the end of the life of the bond. Debt investments include US government investments. So if you've ever heard of Treasury Bills, Treasury Bills means the bonds that the government itself issues, and that's when the government borrows money, right? Municipal investments, sometimes municipalities also, and municipalities, we're talking about like the city of New York or something like that. They also issue bonds, and people can invest in bonds because they are trying to raise money. So let's say they want to, work on the roads, or they want to work on sanitation or something. They may issue municipal bonds and borrow money. And I'm the investor. I'm going to put my money into the municipal bond and expect to get interest, and then also to get my money back. Now, the catch these days is that the interest rates are, so what? Are they very high or very low right now? Someone tell us. Are the interest rates very high or very low out there in the market? Any takers? What do you think? Are interest rates too, I don't want to say too high or too low, because I don't make that decision, but are they quite high or quite low right now? You can tell me in the chat. Let me see if anybody's talking to me, talking to myself, right? Choose one, high or low? Got some people speaking to me. Okay, one person says low and one says high. So I'm gonna tell you that Gion is right. They're very low. In fact, let me just, if we do a simple Google search here, or interest rates low. Okay, so Google can hear my brain. The Fed keeps rates near zero, right? The Fed is setting, the main interest rate, and then everybody else works off of that. I know this is from April, but this is this year, and it's 6 months ago, and not much has changed. The interest rates are incredibly low right now. So now I'm going to ask another question. Sorry, I don't know who is popping up here. I'm going to ask another, it's not even difficult, but semi-difficult question. Why are the interest rates so low right now? What has been happening for the past 18, 19 months that we've all been going through that might have caused the need for interest rates to be low? What is happening in the world that's causing interest rates to be low? It's why we are also having our class online at the moment. Yeah, because of the pandemic, right? The pandemic started and everything shut down. The markets obviously suffered, but they didn't, you didn't see like the stock market and things in general, corporate wise. I'm not talking about people's personal lives, because a lot of people's personal lives were completely destroyed by the pandemic, but I'm talking about like just the financial side of the country. The Fed had to step in and really try to stimulate the economy. And so if you think about your Econ 101 class, if you've been in an economics class, you know that it's really macroeconomics, but I don't know if you guys took macro, but the Fed can step in and do what they call open market operations to try and stimulate the economy. And one of the ways in which they can do that is by, affecting the interest rates and trying to make the interest rate as low as possible. Because the thinking is that if the interest rates are low, maybe people would be able to borrow, they would be able to, borrow more easily, they can get money that they'll spend then in other ways in the economy, etc., right? So every time there's a financial crisis, I mean, this happened in 08, 09 as well. You guys may be too young to remember that, but or some of you may be too young, not all of you. At that time, it was the same thing, that the Fed stepped in and basically made the interest rates almost zero. And we never really came back to a high interest rate situation. In fact, if you wanted to buy a property or something now, the mortgage rates are also at historically low levels. So why am I saying all of this? I'm saying that debt investments are obviously, they're an investment. So it's something that can give you some type of return, in interest and so on. But as you can imagine, because the interest rates are so low right now, it's not necessarily going to be the most attractive investment for someone who is, trying to make money to beat inflation. At least, in fact, this morning, and I don't know if I'll be able to find this article again, for this, this morning it just crossed my news feed. I'm forever not a robot, right? Let me see. Yeah. So inflation jumped 6.2% in October. I'm sure you've noticed that your food costs have gone up. I mean, unless you have connections somewhere, you don't have to pay as much as I do for food, but my food costs have gone way up. And part of that is that inflation is hitting the economy for various reasons. There are supply issues. There are issues with truck drivers not being available to move supplies over. But there's also the fact that the Fed printed money to try and boost the economy while we were going through the pandemic. And there's a lot of things going on. Stores are trying to recover increases in costs by passing those increases on to consumers. So what has this got to do with anything? I'll come back to our sheet here. When you think about an investment, right? Any investment, you're putting your money somewhere, whether you're putting your money in a savings account, you're putting your money into bonds, right? Government bonds, you're putting your money into the stock market and so on. You can't just think about, when I put my money into a government bond, I'm getting 1.5% interest. So, that's great. I'm 1.5% richer than I was before. You have to consider whether you are beating inflation, because if you're not beating inflation, you're actually losing money, right? So if your money is in a savings account at 0.01% at this moment, because of the way prices are going up, you're probably, just by having money in savings and not having it in, and I'm talking about excess funds. I'm not talking about your emergency fund or whatever, your rent money. I'm not talking about that. I'm just saying if you've been working and you have all these savings and you've got all this money and you're not really saving for anything in particular and all your expenses and emergency funds are covered, the fact that we have so much inflation right now means that we're all actually losing some money by having it sit in the bank. And we need to, think carefully about whether there are other ways to invest our money. So why do you care? Well, if you're the investor going into buying debt investments, you're looking at how much interest that investment is returning, and you're also looking at, whether your buying power is, strong in the economy or whether there's a lot of inflation. Okay, so in the examples that we have, they're like from years gone by when, these bonds were being issued at like 10, 14% or so on. So we don't have to worry too much with the textbook examples, but I am talking to you about life, in general. I don't want you to think that, we just go for a debt investment because it's safe and you'll get your money back. You want to compare, your different options. So any questions on that or questions on investments in general? Something that you were wondering that you want to know about?
Do you think it's gonna get more in the winter because of people won't get out that much and work will be get more shorter? And plus the pandemic thing, since the winter gonna hit, it's gonna get more.
What do you think? Are you asking me, do I think inflation is going to go up even more? Is that what you're asking?
Yeah,
Yeah. I think you're right, Mdadul. I think we're headed in that direction, and I'll tell you a few reasons why I think that. I think the reasons that you brought up are right and good. And also this morning when I was watching the news, they were talking about the fact that the cost of heating is for certain types of heating like natural gas, oil, and there was one other thing that I can't remember now. I'm not so familiar with it because I come from Africa where we generally don't have heating in the house other than a normal heater, but there's one other type of heating. It's not electricity or something else. They said that some of those costs were going up by as much as 50%. So that means that, prices are going up for many things. The inflation that I showed you over here, that's the consumer price index. That's like for a basket of goods that, that consumers would usually buy, but other prices are also going up. Heating is going up. The cost of gas has been going up because when the pandemic happened and everything shut down, a lot of the oil producers slowed down their production. But now that everybody's kind of, some people are, or many people are going back to work and things are picking back up, they can't keep up with demand. So prices are increasing. So, when you think about your budget, and I know this is maybe not to do with debt in investments per se, but inflation impacts many areas of our lives. When you think about your budget and your job and all of that, you should be thinking about the fact that prices are going up and what does it mean for you? Like you're saying, Mdadul, now during the winter and so on, do you need to find extra sources of income, or do you have savings available? Are you tracking your expenses? Are your expenses actually increasing and you're not realizing it, and you're wondering why at the end of the month you don't have as much money left over as you used to, right? So plan for some more increases I know it sucks, right? But plan for it. I don't know, you said you work at like CVS or was it Walgreens or something? Do you see that the prices are going up there as well?
it is. The one thing I really hate, I drink coffee. I mean, like not a lot. The milk before was like $2.49. Now it's $3.49.
Yeah.
I hate it so much.
Yeah. It's you perfect example of just a normal staple day-to-day thing that we need. And it's already, a dollar increase is a massive increase on a $2.49, item. That's like just under 50% increase in the price. So I hear you. All right, so this is what we're all facing, and then on top of that, if you do have investments already, maybe you have some investments in stock, or you even have treasury bills, or you have some type of investment, you also have to think about, the return that you're getting on the investment. You have to net it with inflation, and then that's your real return that you're getting, right? Okay, so a bond or other debt investment has a specified date when it matures. You know this already, right? There's a date when they have to pay you your money back. And on that maturity date, the principal, also known as the face amount or face value or maturity value, it all is the same wording, is paid to investors. So the nice thing about a debt investment is that you will get your initial amount, the principal amount, you get it back. So there's less risk in that, but therefore there's also less reward, because stocks, you have more risk, but you have unlimited upside. With a debt investment, well, a stock, you also have downside also, but the debt investment, you'll get your money back, but there's not an unlimited upside. Interest is going to come up, obviously. Interest is equal to the stated interest rate. There will be an interest rate given in the questions multiplied by the principal. The principal is the amount of, the face value or the face amount of the bond. It's paid to investors on specified dates. It's sometimes twice a year, sometimes once a year. I think we have examples where it's happening once a year. The investor values that stream of future cash flows based on the prevailing market interest rate for debt of a similar risk and maturity. So what that means is, if a company comes and says, hey, invest in us, and we, we'll give you 10% interest, give us $500,000 or whatever, a company will still, the company is asking for this money. The investor is going to look at what the interest rates are in the market, right? So if this company says, I'll pay you 10%, right, and the market is actually paying 12%, then the investor's going to say, I'm not going to give you my money. I can go get 12% somewhere else. Then the company has to do something about that and say, okay, and this is where you may remember some of the terms. They may discount the bond and say, okay, you can give us less than the face amount right now, but we'll pay you back the face. So this is what we mean when we say that, you're looking at future cash flows and so on, and then saying what you will pay for this debt investment based on what the market is returning. The other way is also possible, and I'll read through this in a minute because it's explaining the same thing. The other direction is also possible. A company may say, give us $500,000, we'll give you 10%. And the market is only returning 8%. So then all these investors are wanting to come to that company to invest in them because they're like, hey, you're giving 10% and everybody else is only giving 8%. So we all want it. Then the company's like, whoa, there's so many people who want to invest in us now. We can actually issue this debt at a premium. We can charge more, or we can get more cash than the face value of the debt because it's in such high demand. So that's how a discount and a premium is determined, comparing the market interest rate, right, that is prevailing, is existing in the market right now, to the stated rate on the debt investment. And so this is saying the same thing, right? If the interest rate paid by the debt investment is higher than the market rate, investors are willing to purchase the debt for more than its face value, so it's sold at a premium. If the debt investment status rate is lower than the market, they're willing to pay less, and so it's sold at a discount. And this is all coming from the textbook. I'm just summarizing the stuff so that we can get through some of the theoretical constructs a little bit fast, instead of reading through every part of every sheet of the textbook together. And so these 4 steps are also, from your textbook, over the life of the debt the investment. These are the 4 things that we will be accounting for, and we need to make sure that we know how to account for them. So there's the actual purchase of the debt investment. You may purchase it at face value, or you could purchase it at a discount or at a premium. Remember, we are the investor, so it's an asset for us, but it could still be at a discount or premium. There's going to be the interest journal entry. It's saying the whole time, usually it's every 6 months, but again, it can be annual, and I think we have examples that are annual. If it's 6 months, you just divide the rate by 2. Holding the debt investment during periods in which the investment's fair value changes. So this is where things start getting a little bit interesting, okay? Because these are not concepts that we've dealt with together before. So when you invest in, bond payable or some type of debt instrument, it's possible that this debt is actually also being traded on a bond exchange. So it's being bought and sold by people all the time. So the prices are going up and down. And depending on how, and I'll talk about this a little bit more in a minute, depending on how we classify the debt investment, there's 3 ways that you could classify it. We may have to look to see what the fair value of the debt is at the end of, every quarter or the end of the year. And we actually have to say, oh, we are carrying this debt, let's say at 500,000, but we can only sell it in the market for 450,000, for instance, which means we have to take a loss of 50,000. I'll repeat, okay? Depending on how we classify the debt, we may have to look every time at the end of the quarter, the end of the year, to see if this debt is being traded, right, on a bond exchange, to see what the fair value is. What can we sell the debt for today? So if we have the debt in our books at, for example, 500,000, but we look at the fair value and it's saying that it can only be sold for 450,000, we are required by the accounting standards codification to take an unrealized loss of 50,000. All right, so that's new. We haven't, in the past have had to deal with something like this, and I'll show you how to do it, but just bear that in mind. And then the last thing that we have to consider in terms of accounting for these debt investments is that we either sell the debt investment before maturity. So, maybe we don't want to hold on to it anymore. So we sell it to somebody else. And so it's like a disposal. So you have to get rid of the debt. If there's any discount or premium account, you have to remove that. You have to check for any gains or losses on the sale. You have to record any cash that you receive. A typical example, and again, we'll look at that at the disposition or disposal. But the other option is also that you hold the debt until maturity, and that you actually receive the maturity amount, which is the face value. All right. So when you're thinking about how to account for these debt investments, you should be able to, and obviously we'll work through this together, but by the end of this, we should be comfortable with being able to navigate the journal entries around each of these 4 stages of the life of the debt investment. Any questions up to here? Anyone? Before I take us into one example. All right. So I'll just mention the 3 classifications of debt investments before we do the first example. I'm not going to go into deep into subsequent measurement. I'll just talk about the 3 classifications and then we'll do an example immediately. So further, the FASB accounting standards codification, when you have a debt investment, at the time when you invest, you have to classify that investment as one of 3 classifications. So the first one is held to maturity. Here, you're saying that as the investor, you have what they call the positive intent and the ability to hold this investment until its maturity date. So if I invest today, right, November the 10th, 2021, and this bond that I'm investing in is going to mature in 2025, for instance, if I'm going to put it as held to maturity, I'm saying that I have no intention of selling this investment before the maturity date in 2025. And if you decide to do that, then you will account for that investment at what we call amortized cost. And I'll show you how to do that in a second, instead of fair value, because you're saying I'm going to keep this until the thing matures, so I don't have to do the fair value adjustment every year, because I'm not intending to sell it. So I don't really care about what it could be sold for, because that's not my intention. All right. So that's the first classification possibility, is held to maturity. A question will tell you what the company is doing. Okay. You don't have to, come up with this yourself. It will say, that the company is held to maturity, or the next one is trading. So trading sounds like you're buying and selling stuff, and that's exactly what's happening here. This is an investment that is bought and then held primarily for sale in the near term or to generate income. So you're buying this debt investment and you are looking for increases in the price so that you can sell it off again immediately and make a profit. Okay, so they're saying that you are trading in debt investments or in the investment, and you're also holding it in an active trading account for immediate resale. So in this case, and we'll see it later on, in this case, we will carry a trading investment at fair value, because our intention is actually to sell it in the future. So we need to account for any changes in fair value. So that's the second possibility. All right. And the third one is available for sale. So available for sale is a little bit weird, because it's basically saying it's any debt investment that is not held to maturity and not trading. Right. So it's kind of by exclusion, you end up in available for sale. And the way to think about available for sale is that you want to hold the investment basically for as long as possible. But if a good situation arises where you can sell it, you are open to selling it. So you're not in that trading situation where you're constantly looking at the prices and trying to find a good price increase and going to sell the investment immediately. You're also not held to maturity in the sense that you have absolutely no interest in what's happening, you know, because you're not going to sell it. Well, I wouldn't say no interest, but I mean, you're just not planning to sell it. You want to hold it to maturity. So you're kind of in between, right? So that's available for sale. And again, available for sale, you will also do fair value adjustments, but it's just how you treat the gains and losses that's different from trading. And I'll take you through all of that, you know, in the future. Don't worry, we'll get through it all. So those are the three classifications, right? For our purposes. Now, for this first example that we're going to do, it's a more of a, I guess you could call it a, I don't know if I should say a plain example, in the sense that there isn't going to be any fancy fair value adjustments or anything, because it's a held to maturity investment. Okay, so let's read through this first, and then I'll show you how to account for investment in debt that is held to maturity. So Garfield Company purchased as a held to maturity investment bond $80,000. So that's the face value. All right. That's not necessarily what we paid for it. That's just the face value of the 9%. That's the stated interest rates. Remember, that's what we base interest on. 5-year bonds. So the maturity is after 5 years, of Chester Corporation, and they bought it for $74,086. So you think about it for 30 seconds, and someone write in the chat for me, was this investment bought at a discount or a premium?
It's a discount.
Okay, thank you. So it's a discount because what we paid for the investment, $74,086, is less than the face value of the investment. So it must mean that the 9% that is being offered on as the stated rate was probably lower than the rate in the market. So the company accepted less than 80,000 to be able to get the money for this debt. And what ends up happening is, because we paid less than 80,000, that discount combined with a 9% interest over time results in an actual return on this investment of 11%. Okay. And what we sometimes refer to when we look at this return is that this is the yield. This is yield, means give, what something is giving. So this investment is actually giving 11%. All right, not just the 9%. And that's how we attract investors. If we can't give, you know, the 9%, if the 9% is the most we can give in interest, because we do a discount, the yield that the investor gets goes up. All right. So we'll see when we work with this that we need to be aware of the stated rate and of the yield. Prepare Garfield's journal entries for A, the purchase of the investment, and B, the receipt of annual interest. So this interest is not semi-annual, it's annual, and the discount amortization. So here's a new information here, right? What is this discount amortization? Right? Assume effective interest amortization is used, and I'll show you how to do that. I'll also, maybe I should, yeah, you know, we'll build this together. I'm not going to go into the textbook just yet, because it might be a little bit overwhelming to show you an amortization table without context. All right, so let's start with the purchase of the investment journal entries. I'm going, this Google Doc is available to you on Blackboard along with the notes as well. Let me just check myself, but I put it up there yesterday. Yeah, okay, so if you want to access the document, you can, otherwise you can just watch me work. So, so for exercise 1, we are being asked to do the journal entry for the purchase of the investment. Again, remember that we are the investor, that, you know, this is an asset for us, okay? This is not us borrowing. So the way we are going to do this is what we call the gross method, where the company that invests actually keeps a discount account as well. There is an option of a net method, which, you know, I'm not going to get into because I'm going to follow what the textbook is doing. So the first debit here is investment in bonds. Again, this is an asset for us. So the investment is recorded at face value. All right, so be aware of that. That's at face value. But we know that we didn't actually pay 80,000. So we have to account for, and maybe I need a little bit more space here. We have to account for a discount, all right, on bond investment account. And this is some amount which we will figure out, because the amount is going to be the difference between the cash we paid to invest in this debt, 74,086. I'll show you again. It says that we bought this for 74,086. There's the face value, right? So the way we calculate the discount is the difference between the face value and the cash that we actually paid. So the discount is $5,914. Questions, anybody? Okay. So this discount on bond investment, the type of account is a contra asset. Oops, what happened there? Sorry, I'm typing. My hand is not where I think it is. So contra asset, okay? And obviously cash is just the cash that you paid. What do I mean by contra asset? If you're in the asset section of the balance sheet, right, you're going to have the investment in bonds for 80,000. And then you're going to say less the discount. I'm not going to write out the whole name discount and blah, blah, blah. 5,914. And so in the end, the carrying amount, and it may just be the carrying amount that gets shown on the front of the balance sheet, but in the end, the carrying amount of your bond investment is going to be the cash that you actually paid on day 1. All right. As time goes by and you get closer and closer to the maturity date, this discount amount will decrease. And I'll show you how that works now in an amortization table. But the discount amount will decrease to the point that when you get to 5 years being gone and you get to the maturity date, the discount after 5 years, this is what will happen. After 5 years or at maturity, you're still going to have the 80,000, but the discount will be 0. So in the end, the carrying amount on that last day before you have to be paid back your money is going to be the same as face value. That's the whole point of what we call discount amortization. Okay, and that discount amortization happens as part of your interest calculation, which I'll show you shortly. So we did the purchase of the investment. We have to do the receipt of the annual interest. Okay, and the discount amortization. So let me just put this in as A, and then B. Oops, B. I'm not going to do the journal entry yet because I first need to do the amortization table to show you how we come up with the amounts for the interest payment. So, and if you're following with me, or writing down stuff, this is going to be a fairly lengthy business. So to build the amortization table, it's showing how the investment, is basically starting off at a discount. We've got the cash that's going to be paid as interest. It's whatever cash we receive, from the company that we invested in. There's interest revenue that we have to account for. Remember, we're the investor, so it's revenue for us. It's cash that we received. Then there's this discount amortization that I was talking about. It's a little bit strange, and I'll show you how it works. And then there's the carrying amount, right, of the bond. And let me just wrap the text here so we can see everything. All right, so that's a little bit easier to see. Okay, and I'll also bold it. So that's the format of the amortization table. Sometimes the headings are slightly different, but it all comes back to the same thing, that basically you are trying to figure out how to account for the interest revenue, how much of what you are recognizing is revenue, how much of what you're recognizing from the cash that's received is the discount amortization, and so on. So we'll assume that it's a date of January the 1st. The question doesn't really tell us anything about the date, so I'm assuming that it's I'll just say 1/1 over year is the date when we invest, and the carrying amount of the bond is 74,086, right, of our investment. And we have annual interest, so I'm going to assume that the first payment year that we receive is on December the 31st. Again, remember, you are the investor, so you are receiving interest, you are recognizing interest revenue. And so how do we figure out the cash that is being received, right? That's what we have to ask. Remember, we look at the stated interest rate. So the actual rate on the debt investment is 9%, and then we base it also on the actual face value. So this is a contractual rate. It doesn't matter what we end up giving to the company in cash. We are entitled to 9% of 80,000 as interest in the cash that we receive. Okay, so this is going to be 80,000 times 9%, 7,200. And so the cash that we receive every year is 7,200. And let me see if I can make notes on the side here. So cash received is face value times stated interest rate. So it's 80,000 times 9% equals 7,200. I'm doing this because it's important to see these calculations, because it's going to be the same for every amortization table that you're building. I mean, granted, some may have a premium instead of a discount, but the mechanics, are going to be similar. So how do we calculate interest, right? Interest revenue. Surely one would think that surely the interest revenue should be based on the same 9%. But remember that there was a yield, right? The 11% return is what we are actually earning, right? So the way we calculate the interest revenue is actually to take the carrying amount and multiply it by the 11%. So interest revenue is the carrying amount times the yield. So for, year one, let's call it year one, it's going to be 74,086 times 11%. And if you want to remind yourself of these rates, you can say that the stated rate is 9% and the yield is 11%, in case, we don't want to cause any confusion while we're doing these examples. And so you're recognizing, interest revenue at a higher percentage than the cash that you're receiving. And that's because as a result of paying less for the debt investment, less than face value when you bought it, you are actually earning more revenue overall. And the difference between these two numbers is the discount amortization. All right, so discount amortization in this case, that, oops. This line is going to, I don't know why I feel like there's a stickiness in this, in the keyboard. Discount amortization is going to be interest revenue minus cash received. Okay, that's so for year one, it's going to be the 8149.46 minus 7,200. That's how you calculate it. I know this seems super obvious, guys, but when you look back on the stuff at some later stage, I don't want you to wonder where these numbers came from. And then the carrying amount of the bond has to grow from 74,000 to 80,000. So what ends up happening with this discount amortization is that you add it to the carrying amount to increase the carrying amount of the bond, okay? So the carrying amount is going to be prior carrying amount plus discount amortization, right? That's how you come up to the new, can't say equals, new carrying amount. So now you have all the formulas, right, for this situation. So if we were doing interest, you know, the interest, recognizing the interest for the first year, because again, we are receiving the cash, we will debit cash, right, for 7,200, and we will credit interest revenue for 8149. But before we do that, we will amortize some piece of this credit balance. We will debit the discount, right, on bond investment, because the account balance has to get smaller with the amount that we came up with over here. So the 949.46 is going to be the piece of the discount that is going away. Remember, by the end of the 5 years, it has to be down to 0. And then we credit to recognize interest revenue. And the interest revenue is the 8149.46. Questions on any part of this before I show you how to finish the amortization table and that we actually end up on 80,000? Okay, so we said it was a 5-year situation. So what we're going to do is I'm just going to show you the rest of it. So 1, 2, 3, 4, 5. Yep. So the 7,200 stays the same. Okay. It's contractual. You're always going to receive 7,200 for your interest payment. Over here, what ends up happening, and this is the nice thing about Excel, is that, you know, you're saying this is the way you calculate the interest revenue is the carrying amount times 11%. So what I can do is just drag this down. I know this is 0, but it's going to fix itself. I'll also just drag this down, and then I'll also just drag this down, right? So let me just fix some of this extreme decimals here. Well, maybe not that much of a fix. All right. So what ends up happening is you just keep doing the same thing over and over. For interest revenue, you just take every new carrying amount and multiply it by 11% to get your interest revenue. And you subtract from that interest revenue the cash that's received to get to the discount amortization. And notice how the discount amortization is going up and up. In the end, I know we're off by probably a few cents. We're off by 95 cents. So you'll have to round by 95 cents to get to 80,000. But in the end, you are back at 80,000, right? You actually, through the discount amortization process, you've grown your carrying amount of your bond to 80,000 by the end of year 5, which is, in line with what we said here. It's a 5-year bond. That's what we expect. And over here, let's see if we can figure out what's going on with this discount amortization business. Other way, sorry. 5913.05, we're off by the same 95 cents, but 5914. So basically what this is showing, and I'll draw a line here so you can see that it's a total. We have amortized the entire discount, right? Over time, we've gotten rid of this entire balance. I'm not gonna kill you by doing every single journal entry, but basically as you account for the bond over time, the discount balance gets smaller and smaller until it is down to 0. The carrying amount grows and grows until it is up to 80,000, and you account for your cash obviously as a debit. You've received, all this cash over time. It's 9% times 80,000 for 5 years, and then this is the revenue at 11% on the carrying amount. Questions about the amortization table? So, just to add excitement to our lives, in chapter 14, we will be on the other side of this transaction where we will actually be the borrower, and we'll have to do amortization tables again, but it will be, from the other perspective. So remember, yeah, we're the investor. And just to reiterate, the journal entry for interest, I'll just do year 2. I know it's not asked for, but I'll just do year 2. So it's cash, the same 7,200, right? Discount, well, I can even just do discount on bond investment. So I'm picking up this one. I want to show you how easy it is once you have the table. You basically just pull the numbers off the table, right? And then interest revenue is going to be this number over here, right? 82. And we make sure, yeah, we're pulling all the numbers, but we still make sure that, why is this not in the sum? Let me see. Oh, because it's on sum. Okay, yeah, we just make sure that we still balance out. I mean, I know we do, but you don't want to just randomly pull numbers off the amortization table and they don't actually work. So that's the accounting for an investment in a bond that is held to maturity. So it is carried at amortized cost. And let me just be clear here, this carrying amount is what is amortized cost. Okay, so when you read in the notes or you are reading in the textbook and you see the words amortized cost, what they mean by that is this balance over here. You're either amortizing a discount or a premium, or obviously if there's no discount or premium, you're just carrying the held to maturity bond at face value, but they still refer to it as amortized cost. Okay. Questions on anything here? Okay. So I'm going to leave it there for today. I'll give you back a few minutes. I'm going to stay on until 12:45. I want to keep that time open. If anybody has questions about the homework, has questions about the paper, has questions about the work that we just did, whatever the case may be, you can stay on. If you don't have any questions about anything, you're welcome to be dismissed and, enjoy 30 minutes before you have to join the Reg Hour with Raphael. But I can see people are leaving already. But if you have questions, stick around and we can talk. Otherwise, you should be ready for starting the test and the quiz tomorrow. I do have everybody's attendance.